Hello friends, welcome back to our channel SNK and Company. I hope you are doing well. Let us begin today's video with another round of important and practical updates from the world of taxation, GST, and corporate laws. These judgments are highly relevant for taxpayers, professionals, businesses, and compliance teams, so do stay with us till the end. We begin with key developments under the Income Tax Act. The Telangana High Court, in the case of AG Biotech Laboratories, India Limited versus the Income Tax Officer, delivered an important ruling on agricultural income. The court held that where the assessee carried out cultivation of mother plants on land involving all basic agricultural operations as contemplated under Section 2(1)(a), and the subsequent tissue culture process was only an advanced scientific method of propagating and multiplying plant material derived from those mother plants. The income earned from sale of tissue-cultured plants would qualify as agricultural income. Accordingly, such income was held to be exempt from tax under Section 10(1). This judgment provides significant clarity for businesses engaged in modern agricultural practices and biotechnology. In another notable decision, the Kerala High Court in Aspinwall and Company Limited versus Commissioner of Income Tax dealt with the allowability of interest paid on delayed payment of agricultural income tax. The court held that such interest expenditure is not allowable as a deduction under the Income Tax Act. The reasoning was that delayed payment of agricultural income tax has no nexus with the business interests of the assessee. And since the principal amount of agricultural income tax itself is not deductible, the interest paid on delayed payment also cannot be allowed. This ruling reinforces the principle that statutory levies unrelated to business operations cannot be claimed as deductible expenditure. The Bombay High Court, in the case of Vallabhji Malsi and Company versus National Faceless Assessment Center, highlighted the importance of natural justice in faceless assessments. The court observed that the assessee was denied a reasonable opportunity to respond to the show cause notice due to holidays and an inadequate notice period. Further, personal hearing was not effectively granted as mandated under Section 144(6)(x). As a result, the assessment order, consequential demand notice, and penalty proceedings were held to be vitiated due to breach of principles of natural justice. The court quashed the proceedings and remanded the matter for fresh consideration in accordance with law, reiterating that procedural fairness is non-negotiable even in faceless regimes. Moving to the tribunal level, the Mumbai Tribunal in Alex Grinders Private Limited versus Deputy Commissioner of Income Tax dealt with the allowability of payments made to a labor union. The assessee company had reached a settlement with its workers through the assistance of a labor union and made payments to the union for facilitating such settlement. The tribunal held that since the assessee established a clear nexus between the payment and its business activities, and the expenditure satisfied the test of commercial expediency, the same was allowable as business expenditure under Section 37(1). This decision underscores that substance and business necessity prevail over form when examining allowability of expenditure. In another important ruling, the Ahmedabad Tribunal in Assistant Commissioner of Income Tax Exemptions versus Vyakti Vikas Kendra, India, examined the charitable status of a trust engaged in yoga training. The tribunal held that where the predominant object of the trust was to provide practical and theoretical training in yoga, which ultimately contributes to medical relief and well-being of society, such activity would fall within the ambit of imparting education under Section 215. Consequently, the trust was held to be eligible for exemption under Sections 11 and 12. This judgment provides clarity for charitable institutions engaged in alternative health and wellness education. The Bangalore Tribunal, in Deputy Commissioner of Income Tax versus Mathikari Ramaya Sitharam, addressed an important issue relating to joint development agreements. The tribunal held that mere entering into a JDA under which the assessee was entitled to receive a fixed percentage of revenue from sale of developed flats does not convert a capital asset into stock in trade. Further, revenue sharing by itself does not make the assessee a real estate developer. Accordingly, it was held that no transfer had taken place within the meaning of Section 247(v) or Section 247(v) in the relevant assessment year. This ruling provides much-needed clarity on taxability timing in JDA transactions. Let us now turn to important updates under GST laws. The Authority for Advanced Ruling in Tamil Nadu held that where an online logistics portal merely facilitates freight payments between shippers and carriers, GST liability arises only on the commission or subscription charged by the portal, since the freight service is actually provided by the carrier to the shipper, and the major freight amount is paid directly with the balance merely routed through a separate account without any deduction or use by the portal. GST cannot be levied on the freight amount. This ruling is significant for digital platforms operating as intermediaries. The Punjab and Haryana High Court delivered an important ruling on negative blocking of input tax credit. The court held that negative blocking in the absence of available ITC in the electronic credit ledger is impermissible. The department, if it believes that credit has been wrongly availed or utilized, must follow statutory adjudication and recovery provisions rather than resorting to such blocking. This decision strengthens procedural safeguards for taxpayers. The Allahabad High Court dealt with a high-value ITC fraud case involving a chartered accountant. In this case, bail was granted to the CA despite allegations of involvement in an ITC fraud of Rs 40 crore. The court noted that the accused had already been in jail for almost 2 months. The prosecution case was entirely based on documentary evidence, and the trial was likely to take a considerable amount of time. This judgment highlights judicial balancing between investigation needs and personal liberty. We now move to important developments under other corporate laws. The Karnataka High Court dealt with a case involving voluntary delisting and reduction of share capital. The court held that proceedings initiated under the SEBI Act, read with the Securities Contracts Regulation Act, for failure to maintain minimum public shareholding are distinct from proceedings under Sections 100 and 104 of the Companies Act, relating to reduction of share capital. Accordingly, approval of a reduction scheme by the company judge could not be denied merely because regulatory proceedings under securities laws were pending. Finally, the Supreme Court delivered a significant ruling under securities law. The court held that where a company failed to promptly disclose unpublished price-sensitive information regarding ongoing negotiations between its subsidiary and Facebook, it amounted to a clear violation of the listing obligations and disclosure requirements and insider trading regulations. The Supreme Court upheld SEBI's findings and confirmed the penalty of Rs 30 lakhs imposed on the company, reinforcing the importance of timely and transparent disclosures in capital markets. With this, we conclude this week's tax and corporate law updates. If you found this video useful, do like, share, and subscribe to our channel SNK and Company for regular and reliable legal insights. This video is for educational and informational purposes only and should not be treated as legal or tax advice. Please consult your professional advisor before taking any action. Thank you for watching, and we will see you in the next update.